All right, guys, what's going on? It's Josh again, and today I want to talk some basics about bonds. And now this relates to the stock market in many ways, and I want to share those ways of how you guys could look at it. This is when it comes down to me looking, how I find my information and finding stuff about stocks. I'm looking at, global indicators and stuff going on with the world and bonds. It's great to understand how they work for business sake and in general of how it could affect markets and stuff like that. It's one of the biggest financial markets in the world, which we are going to talk about. So, again, too, if you guys are new, check out the free stock trading course. I kind of talk about this stuff with understanding business and how it relates to the stock market. And make sure you guys subscribe and like the video if you learned anything new, and put up post notifications. I've been very busy. I have a bunch of trades I want to share with you guys, some pretty cool trades. Again, a couple thousand percenters. I want to post those. I just haven't had time to get those edited, but make sure you have post notifications. Now, getting into a bond, why I'm going to talk about it. Like I said, it's important for the global economy and to understand them, but even businesses, we're going to go over some filings. We're going to go over an Apple filing and see kind of how bonds just relate to general business and a lot of applications just for real world. It's just kind of crazy how much people don't know about bonds, which is so surprising. I've talked to a lot of people. They are kind of confusing, but very, very simple. And I guess now, to start the discussion, what is a bond actually? How does a bond work? In essence, you are simply loaning money to somebody and they are agreeing to pay you back all the money you gave them plus a set amount after a certain amount of time. Some of the similar factors as an option, right? With time and what you receive back now, that's going to usually be fixed. Bonds could be variable, which means it changes, but most of the time bonds are fixed income. And you're going to hear names for them. There's pretty much senior secured. And, the thing about bonds is they're not really backed by anything. It depends on the type of note or debt you're buying. And a bond is debt because a company or person's taking it on and then they're offering to pay it back to you at a later date with interest. So you have to understand how bonds function as a debt instrument. And again, companies use them because it's just a great way they could get money at a cheap rate, and that's what we're going to talk about. But now there's also the government bond. So essentially, a government bond, instead of it's the like I said, it's not backed by anything. It's just really the reputation of the bondholder is what lets you know if it's a good or a bad bond, if it's good or bad quality, and how good or bad quality is going to change the interest rate. So companies, again, it's not secured, but if it's a good company, the bonds are going to, be higher quality. And we're going to talk about that. That's where bond ratings come in. But now countries operate the same thing. Countries use bonds as well. You've got, US government bonds and then US treasuries. Those are in the T notes, which is pretty much separated by time, but the government does the same exact thing. The government comes in and they say, hey, we need money. You give us money, we will pay you back at a set rate. And investors, banks, hedge funds, everybody does this because it's a good deal for the most part. And it's interesting because some bonds around the world right now are at a very, very interesting state. But sometimes it's a good deal. But I'm going to explain what makes it attractive for most people, and then how you could get stuff from the market from that. So there's the basic rundown of the bonds, and then countries use them to raise the money, pay for debt, taxes that they have, or pay for like in salaries and whatever stuff the government needs to operate, pay the people, the employees of government services and whatnot. So back to another quick thing with it is going to be now the bond rating. Like I was saying, if the company is good, or in this case, even the country, if it's a good, high quality, pretty much, and how do you determine that? It's the chance of repaying it back. So if the bond has a high chance of being paid back, it's a higher quality bond. That means the person issuing the bond or taking the money is of good standing. Their financials are good, their history of repayment is good. And that's one thing that happens, is that sometimes some companies, even some countries, but it's just very rare, they default on their debt, meaning that they fail to pay back the money at a certain amount of time. That means they defaulted, failed to pay, and the bond rating of it will downgrade. Essentially, how you could look at bond rates is like credit score. If you have a high credit score, if you're a good quality borrower, your interest rate is going to be lower. If you are riskier, you haven't paid back stuff in the past, you have judgments on you for not paying something back, On the reverse end, you're going to have a lower credit score and you're going to have a higher interest rate because it's just more riskier on that end for the lender. So that's the same thing with bonds. You're giving money to someone, they're the borrower. So if they have a good, rating, if they're good standing, it's going to be a lower interest rate. Why? Because it's just a no-brainer. If it makes a lot of sense, they're not going to pay you a lot of money to get it because they don't need to. Just like having good credit, you're not going to pay 17% interest to get money to use on credit. When you have a good history, somebody will give it to you cheaper. So the higher quality, the higher the bond rating, the lower the yield. Now, looking at it on the other end with bad bonds, if they failed to pay before, they have a bad bond rating, they have way more debt than their assets or earnings for the next 10 years. It just doesn't make sense how they have that much debt. It lowers the odds of your repayment. The bond grade is going to be lower. So they go by scales of like B, double B, triple B, triple A rated, triple A plus, stuff like that. Obviously, the more A's and pluses, the better. But essentially anything below, I believe, a double B or triple B is considered junk. So the standard is pretty high, and you could even tell what junk bonds are. Junk bonds usually have a price or a yield above 6%, and that's what we're going to talk about. Because now, if the company isn't a good company or they have a bad bond rating and it's a riskier investment, bad bond rating, lower credit score, higher interest rate, that bond is going to pay a higher amount because they need to entice investors to hand them a blank check, literally give them money, not backed by anything, just a promise. And that's all a bond is. It's unsecured. So and that's kind of how the credit things, it's kind of the reverse because you're going to be the borrower. So essentially, higher quality bonds have lower rates. The riskier asset looks, the higher the bond rate is, and that's what makes sense. And then there's also now supply and demand, and that comes into it. So you could even tell, like, why is it that America's 10-year bond is 2.8 now? That's a low return. UK 1.24, Germany 0.3. And go look at Russia and India, those have 8% bond, their bonds are paying 8% on a 10-year. These are a government bond. That could tell you kind of the growth potential and also the risk that you're taking with that bond. America's obviously more stable. The odds of America having anything bad happen where America fails to repay one of its bond payments, which never happened, that's pretty low. 2.8, it's decently high. But then, you go look somewhere like Russia or India, they're at risk, especially with stuff going on, and their governments are offering a higher rate of return to bring in that money. Now, something interesting, you guys, I don't know if you've ever watched these videos and understand how the economy works, but bonds and government bonds, that is how they bring money into the system. So when the Federal Reserve, it's a private owned entity, they print money and they add money to the circulation. How do they do that? They don't just throw money, and just start handing it out and give it to banks to give out free money. It doesn't work like that. What they do is they buy the short-term government bonds, and so the government offers, let's say 2% or 1.75 on the short-term bond, or the 3-month treasury, or even the 10-year, the Federal Reserve will come in, print a bunch of new money, and buy those bonds. They give the money to the government. The government says we'll pay you back 2%, and the Fed does get that 2%. And then the government takes that money and uses that to pay its employees, this and that. And that's how all the new $100 bills come into circulation. So, bonds are very, very important, and companies use bonds to raise capital. So they're using bonds to do things. That's what even Apple does. You'll even see, I think, total long on a 10K. This is the 10K, the yearly statement for Apple. If you look at total long-term debt, there's another one. I think they add up all their stuff, but they have about, in total term debt, or if we even look at long-term debt, that's how it's classified on a balance sheet. That is how much money is borrowed by bonds. So these numbers are in millions. Apple has over $97 billion in bonds that they've taken out, meaning, or debt through bonds. And you're going to see they all have different time frames, different interests, and different terms. And these are corporate bonds, and they even have their commercial paper, which is more their shorter term. It even says below generally maturities with a less than 9 months, and that's what it's called. The yield given on a bond is called the maturity. So it's saying when does it mature as the time frame, and then what type of price do you get at maturity? How much is it going to be worth? And that's usually factoring in the interest. So bonds are used by everybody. The government doesn't, companies use them, and now it's a good way to get capital. It's a good way to raise capital for these expenses, to raise a lot of capital. But now, who in the world is buying these? That's where we want to focus on, because when it comes to understanding how stocks, bonds and the bond market affects the stock market, the bond market is one of the biggest in the world. The thing about bonds is that you got bonds, you have some of the biggest investors in the world seek to these. Why? Because it's safe. You have to think about it. It's fixed income. You give a company like Apple your money for 9 months, and they're going to pay you back what? See, so they have their commercial paper average rate of 1.2%. So, I could go give Apple, oh, why is it doing that? So I could give Apple $1 million, and they're going to give me 1.2% back in 9 months. Now, that's a lot of money and it's not bad. But now imagine if I wanted to invest way more than, $1 million. Imagine I wanted to put $100 million on my hedge fund, and in 9 months, I'll get a guaranteed 1.2%. That's $1.2 million. That's doing nothing. Now, that's not a lot comparatively to the amount. And it just does. Obviously, people could get rates higher. You could buy the S&P, and that's what happens. You have funds and everybody, this is part of their strategy. They buy a portion of bonds so they could guarantee, fixed income, so they could guarantee some return on these larger amounts of money. And that's where bonds go to safety. If you have $100 million, billions of dollars, think about the big companies in the world. Think about, very rich investors. What are they doing? You don't just leave a couple $1 million laying around when you could put it into a bond. Now imagine you're getting 2-3% in a few months, a few years. It's better than staying in cash when you have inflation. And we'll relate that too now, because inflation is also going to affect the bonds, and we'll talk about that. But if you have inflation killing your money, you don't want to put it in stocks, which, $100 million, you don't want to put it in Facebook tech, could go down 30%. Even then, Johnson and Johnson, stuff that moves too much, you might put a little bit there, but you don't, if you're uncomfortable, you're going to put it into a bond, something safe. So now you're either going to get commercial or government. And that's pretty much where looking at bonds could give you guys insight, because when you start to see bonds move and the bond rates are moving drastically and they're doing stuff they haven't in a while, this is kind of letting you know where people are moving their money. If bonds are pretty much, if you see rates going down, that's actually as a result of demand. And if you see rates going up, it's vice versa, and you can, it's so much to talk about to understand the prices. But essentially, when you see people going in and out of bonds, it could even just tell you the general idea of how people are perceiving the market, what they think, and why are they moving to there. Because if they think, something's worried, they're going to go into bonds. If they don't trust the country, the currency, they're going to move out of bonds. Because that's the thing too. If you're expecting inflation, bonds kill you. Because now if you're supposed to get back $1,000 with 10%, get back $100, let's say, or $1,000, but inflation goes up, if you get the same amount of money plus interest, but now your dollar gets you less, you really lost on that bond deal. But now if there's a strengthening currency, bonds will actually help you out. So we're not going to get too much into those strategies, but simply looking at how when bonds move, they're letting you know where some of the biggest investors in the world and bigger funds, when you start to see those movements, you could start to tell what's happening, or just get a general idea. It's not as long, as far as saying you want to predict something, but you could get an idea of how bigger investors are moving their money and their sentiment towards countries and certain investment opportunities, and if people are kind of going risk on or risk off. So I'll leave it there. I know this is already long, so I don't want to keep dragging it on, but hopefully you guys learned something. I'm sure there's a lot of questions. Let me know what we should continue on for part 2. But love you guys. Drop a like, subscribe. Peace out.